This week has been a further week of instability and tension for global financial markets, with China and the US remaining in focus. Starting off with China, we saw there with the PMIs that were released earlier this week was a further sub-50 reading for both the Clarkson and also the official measure for the PMIs, and that's the 6th month in a row where both those indexes have remained sub-50, emphasising that we have seen a contraction in activity over that period. In terms of sort of what's driving that weakness, external demand is quite soft. We have seen across the developed world that growth hasn't been as strong as we would have hoped, and that's particularly the case for consumers' discretionary spending, and that's having an impact in terms of orders coming through from the global sector to Chinese manufacturers. At the same time, heavy industry and construction within China is quite soft, and that's having a major impact on demand coming from those domestic sources as well. Unsurprisingly then, given that broad-based weakness, we have seen a further reduction in headcount at Chinese manufacturers. Again, that has been weak for a number of months and has been quite a persistent trend we have seen in that sector. It really emphasises both in terms of the growth activity and also that employment outcome. We really need to see continued robust growth in the services sector in China to really offset those negatives and see robust growth going forward at the aggregate level. That's really been driven by the rise of the Chinese consumer, which is obviously demanding a great deal more in terms of tourism and education, both internally and externally, and at the same time also seeking to go and experience, I guess, more of a developed world culture in the sense of sort of eating out more and all those kind of other services which developed world countries tend to consume a lot more of than the developing countries that China is emerging from. In terms of the US, the focus there has really remained on the Fed. The GDP review that came out last Friday, as well as the ISMs we have seen this week, both point to quite a soft aggregate growth pulse, and that's obviously, I guess, re-emphasised to markets that there is a great deal of uncertainty over the short-term picture for the US, and they've acted accordingly by pricing out rate hikes all the way into the end of this year, or if not into early next year. We don't believe that's likely to be the case. We continue to believe we will see further rate hikes from the Fed later this year. It is really quite important to remember that domestic demand, as per Q4 GDP, is still relatively robust and is likely to strengthen as we move into this year. There's still a great belief in the consumer in the sense that they have seen a significant decline in oil prices. They are seeing real wage gains, and also the employment growth remains quite strong. All of that paints a relatively positive picture for the consumer, and then should lead through to stronger investment going forward as well. So that's really going to be the focus going forward. It is fair to note that, as I mentioned, the short-term picture is, I guess, a lot more uncertain, and that means that the Fed may well decide to actually stay its hand in March. We have seen comments from Dudley and also from Barnard this week emphasising that they are willing to, I guess, wait it out and try and offset the uncertainty we're seeing in global markets with a degree of more certainty and stability from the Fed's perspective in the next couple of months to try and help confidence rebound and strengthen going forward. So that's going to be quite important to watch as we move into the March meeting as to how those comments change as we move over the next month or so. For Australia, we have seen the RBA meet for the first time in 2016. They took, I guess, a more open-handed view to policy. They did sort of emphasise the risks that are on the global outlook. But at the same time, they're balancing that against quite strong domestic demand conditions. Unemployment's at below 6% now, and we have seen a continued rise in business conditions to well above average levels. So that's painting a relatively optimistic picture, both for the consumer and also for businesses going forward. And they are continuing to hope that that will come through. At the same time, we are still benefiting from the lower Australian dollar as well, albeit not quite as low as it has been sort of late last year. So there's a lot of points of tension at the moment in both the domestic and the global sphere, and we'll come back next week and inform you of what's been happening there next week.